When you buy a home, there are two components that determine what price home you can afford. The first is your mortgage amount, or the money you borrow from a lender, and the second is the down payment, or the money that you contribute to purchase the home. The down payment is money that you put in when you purchase the home that you do not get back until you sell the home. So if something unfortunate happens, such as selling your home for less than what you paid for it, or your home going into foreclosure, then you could lose part or all of your down payment. Borrowers frequently ask what size down payment they need to buy a home, as saving money for a down payment can be challenging. There's no set rule for what size down payment you need to make when you buy a home, but there are some guidelines and financial considerations you should be familiar with. In order to receive the lowest interest rate for your mortgage, most lenders expect a borrower to make a down payment of at least 20% of the purchase price of a home. For example, if you're buying a home for $300,000, if you want to receive the best interest rate, your down payment would be $60,000 and you would borrow the remaining $240,000 from the lender. Lenders have guidelines that specify an acceptable loan-to-value ratio, or the amount of money they are willing to lend you compared to the value of the home. Lenders typically expect a loan-to-value ratio of 80% or less, which means you're making a down payment of 20% or more. If we use our current example, our mortgage is $240,000 and the value of the home is $300,000, so our loan-to-value ratio is 80%. $240,000 divided by $300,000 equals 80%. It's important to point out that in addition to your down payment, you also need money for closing costs when you buy a home and get a mortgage. Closing costs are the fees and expenses you pay to third parties, such as the lender, appraiser, title company, an escrow company, or attorneys to process and close your loan. Closing costs vary by mortgage amount, program, geography, and lender, but let's use $5,000 for closing costs in this example. So if we add our $5,000 in closing costs to our $60,000 down payment, the total upfront money required to purchase the home in this example is $65,000. So a 20% down payment is the standard down payment when buying a home, but it is certainly possible to buy a home with a smaller down payment. If your down payment is less than 20%, the lender will likely charge a higher interest rate or require the borrower to purchase private mortgage insurance, which is also known as PMI. PMI is insurance against loss from mortgage default provided to the lender by a private insurance company. PMI requires that the borrower pay an ongoing annual fee on a monthly basis. PMI rates vary but can be approximately 0.45% of the mortgage amount for a 30-year loan with a loan-to-value ratio of 90%. So when the borrower makes a down payment of 10%. So for a $100,000 30-year fixed-rate mortgage, the borrower would be required to pay approximately $450 a year or $38 a month in PMI. The borrower only has to pay PMI as long as the loan-to-value ratio is greater than 80%. So if the borrower pays down the mortgage balance over time, or if the property value increases, the borrower can request to have the PMI fee removed, although this can be a time-consuming process. Instead of charging PMI, some lenders may charge a higher interest rate. So the lender may offer you an interest rate of 4% if you make a down payment of 20% and an interest rate of 4.5% if you make a down payment of 10%. In many cases, paying a higher interest rate can cost the borrower more than paying PMI fees because the borrower pays the higher interest rate over the life of the mortgage unless they are able to refinance. So if you decide to make a down payment of less than 20% and the lender does not require that you pay PMI, be sure to ask the lender if PMI is included in the interest rate, and if the answer is yes, which it should be, ask what the interest rate would be if you paid PMI separately, as this could save you a significant amount of interest expense over the life of your mortgage. There are also multiple government-backed programs that enable you to purchase a home with less than 20% down. With the FHA Home Loan Program, the borrower is only required to make a down payment of 3.5% of the purchase price of the property. The FHA program requires the borrower to pay an upfront and ongoing annual mortgage insurance premium, which are additional costs on top of other closing costs and your monthly mortgage payment. The VA Home Loan Program for active and retired military personnel requires no down payment, although the borrower is required to pay a one-time upfront VA funding fee in addition to other mortgage closing costs. Please note that the borrower can include the upfront FHA mortgage insurance premium or the upfront VA funding fee in their mortgage amount, so they may not have to pay these fees out of pocket when they get their mortgage. So, to summarize, you can buy a home with less than 20% down, but it is going to cost you more in fees or increased interest expense. We encourage you to review related freeandclear.com videos such as what price home can I afford and what size mortgage can I afford, in addition to our down payment calculator and detailed discussion and example of determining your down payment in the mortgage process guide on freeandclear.com. Thank you for reviewing What Size Down Payment Do I Need to Buy a House with freeandclear.com. freeandclear.com.